Hi, everyone. Welcome back to Be Rich on our continuing series of investing and financial freedom. I thought today we will talk about this thing that everyone wants. Everyone wants to retire, everyone wants to quit working and be free from work and start to enjoy life. How we all want to retire early and have financial freedom and start reaping the benefits of our investments. So, based on that, I thought I'll talk to Shashwat about that. So, what is financial freedom, Shashwat?
Yeah.
Everyone keeps saying.
So financial freedom is the idea that you can just quit your job the day you want to. You're just working at the job you want to because you want to. And there's no necessity for you to work there for your subsistence. And if financial freedom means that if you don't want to, you can quit today and put your hands up and say, I'm going to live the rest of my life retired. And I'm not going to work a single day after that for money. So that is financial freedom. And financial freedom also implies a few things. One, it can imply that you maintain your standard of living. Two, you can also live in a at a lower standard of living, lower quality of life. But that can also mean financial independence depending on what your personal needs are.
Yes, and to go further a little bit and say financial freedom does not mean retirement. It means not doing the work you don't want to do and doing the work you want to do. So let's say you always wanted to pursue photography, but because of financial lack of financial freedom, you cannot go pursue photography. So you've not been able to pursue your hobby. So if you do get financial freedom, you can start pursuing your hobby and make that into a main stream of work. So you don't have to retire specifically if you want financial freedom. What financial freedom means is pursuing also the kind of work and doing the vocation you want to do. So let's say it could be whatever you want to do. It's not because of you're not working because you need the money. You're working because you enjoy the work. That being said, Shashwat, what is the difference between needs and wants?
Yeah. So your needs are things which, I mean, as the definition says, something which you need and can't go without. So this can be your food, this can be your basic shelter, and this can be your basic clothes. And maybe you can stretch it a bit further and say your education can also be a necessity. And these are things which you cannot live without. Humanly, it's not possible. And these are things which you can go ahead and buy as long as it's reasonable. That is, your needs are to the point where it satisfies the necessity part of it. And now we go into the territory of wants. Wants are things which you don't particularly need for your subsistence. That is, you can live till the next day without these things, or you can go your entire life without ever having these things, and you can still live a very normal life. And these can be, you can take your needs and you go too far with your needs. So you may need a car for your transit to work, but you don't need a BMW. You may need clothes, but you may not need your Gucci, Prada, and all your other big brands. And that is the idea of needs and wants. And wants can also mean things which may be necessities at a fundamental level, but you've blown it to a size where they stop becoming necessities.
And also, please remember, each person's needs and wants are different. Depending on your work and your job or vocation, your needs and your wants may vary. Like Shashwat rightly said, you may not need the latest phone. But if your job is such that you're like a vlogger or you're doing something related to YouTube, maybe investing in that equipment is a need, it's not a want. So your friend might look at you who's doing some other vocation, look at you and say, hey, you don't need this. You're just wanting it. But he may not understand, but for your job, it's a need, it's a necessity. So you have to see the checks and balances on this and keep it in mind and assess it on an individual level. What is your need and what is your want? And not feel guilty about your needs and wants, but be more practical and not be judgmental on your needs and wants. That being said, what are the effects of inflation when it comes to your financial freedom, Shashwat?
Yeah. So your financial inflation is like a river which is eroding away the riverbed, and the riverbed is your savings. So your investment and your savings constantly get eroded away by inflation. Whatever returns you're making, it's moving you forward, but inflation is like acting in the opposite way and reducing the effects of your growth. So this is the fundamental idea. If you have 100 rupees, the 100 rupees is not the same a day from now, a month from now, a year from now, and 10 years from now. And depending on the scale of the time which has passed by, your 100 rupees might have eroded all the way to 10 rupees. So the idea here is that you want to account for this eroding factor, and you may want to keep 200 rupees in your reserve or 300 rupees in your reserve and account for the fact that don't know what the inflation rate is. And there's no telling. You might have very reasonable inflation rates of 3 or 4%, which is eroding away your money at a reasonable rate. And maybe next decade, some lunatic comes into power and erodes all monetary policy away, and your inflation rate is standing at 10%. And you can't go back and start earning more in the past. So you're stuck with what you have. So it's very important to understand that inflation is a factor which you have to account for, and it's always better to be on the safer side than on the riskier side.
Very well said what Shashwat said, especially when you can't predict the future. For example, a good example would be what Russians are going through. 10 years ago, a Russian guy who was just leaving college couldn't have imagined his country being in the situation as it is in right now, his currency being in the doldrums it is in right now. All his investments and inflation, everything put together has gone out the window, and he's in shambles. So keep this in mind. Keeping this in mind, I want Shashwat's advice where to invest.
Yeah. Where to invest depends on where you are in your life and what you need out of your investments. So there are two broad classifications, equity and bonds. And this is because real estate now is not priced too well. So we'll stick to equity and bonds. And under equities, we're also talking about mutual funds, and bonds also we're talking about mutual funds. So under these two broad asset classes, I want to look at the impact of inflation, economic expectations, where you are in the point of your life. So if you are a youngster and you are someone who has a long runway, yes, there's no telling that whether you live till 80 or 70, but generally speaking, someone who's in their 20s has a life expectancy of 80 if you're taking care of yourself. And speaking of that, if you're a youngster and you don't need much out of your investments in the next 20, 30 years, then what you can do is invest in wealth building assets, which is basically equity. Equity gives you a higher rate of return over a long period of time. Yes, there's volatility, but you can account for that volatility. That volatility doesn't bother you as much as it might an 80-year-old on his deathbed. So equity is the place for you to be if you're a youngster. And over the next 20, 30 years, you slowly sip away. And this was talked about in one of our previous videos. But you slowly slip away small amounts, and you have a huge amount of retirement savings for you to look forward to when you're about 60 or 70 years old, depending on whenever you feel like retiring. And some of you might want to retire, and some of you might want to go into your passion jobs. And your retirement savings basically allows you to do that. And that being said, in The Intelligent Investor, Benjamin Graham also says just because you're young doesn't mean that you don't need fixed income. So, for those of you who need fixed income, for let's say those of you who have aged parents and you have people who are depending on you and you have this lump sum amount of money, you might be better off in the bonds camp. And you might have want to put your money and park it into a place where it gives you a decent return of, let's say, 12% per annum. And you take this 12% and it adds to your income, and you're able to support your family members. So age is not, it's not a hard and fast rule. It's something which is flexible. And and I've already given a sneak peek of people who are interested in bonds. Bonds are for people who are on the latter half of their life cycle, and you want a solid place you can park your funds, where you get returns, and you have to live off of those returns. That is the classic case for people who invest in bonds. So investing in bonds guarantees you that 10 or 12% which you're looking forward to, and you can ration your lifestyle according to that, and you can live off of that. So the idea here is to whether you want wealth building, wealth preserving, and whether you want fixed income, whether you want growth. So these are your classifications which you might want to juggle around with. And there's no fixation that you have to be in one camp or the other. The one investment idea which can be is that you park a little amount of money in equities, but you're saving up to buy bonds. This can definitely be something which can be an investment style for youngsters as well.
True. And that being said, the best way to hedge against all these kind of volatilities and geopolitical situations in the long run is also to diversify your investments. Like you can be playing in an American market too, sitting in India nowadays. So you can keep some of your investments in American markets. You can put some of your investments in European markets. And some of you are IT professionals working outside India. So you have far more freedom and you're eligible to do a lot more. So you can investigate the different avenues you have available to you to invest. It is gone the days of old where everything had to be in gold. It doesn't have to be in gold. That was true for our parents and our grandparents who didn't have many options, who did not have an equity market to look at, who only looked at gold and real estate because there's no other option. But nowadays we have a plethora of options. So I would strongly suggest that all youngsters look at all your options and see where your future is going and think long term and not short term in all your investments. That being said,
And
another important thing, yeah, Aaron, jump in,
I
Sasha.
just quickly want to add that exactly, and another problem with gold when it comes to retirement is that yes, it preserves value, but it doesn't build value. And gold doesn't give you a fixed income, where if you buy a gram of gold, it's not going to give you 0.001 grams every year. The problem with gold is that yes, it's a great way to keep your money, but at the end of the day, it doesn't give you any return. And building towards your retirement, you want to be able to have yes some amount of contingency funds in gold, emergency funds which you can break into whenever you want to. But that being said, predominantly most of your investment should be in productive assets like bonds, equities, and real estate if the price is right.
Correct. And another thing to keep in mind is if those of you who do not have a safety net below you, who do not have a protection plan already existing for you, is to invest in some kind of medical insurance, which takes care of those rainy days, and also to have general insurance, a single policy, one term policy. If you have dependents upon you who are relying on you, like a family or a spouse who needs your earnings to be there, feel secure. Make sure you do look that, take that into consideration, and do not forego on health insurance and some kind of general insurance if it's required for you. That is something to keep in mind. What do you say, Shashwat, for that?
Yes, and insurance is a no-brainer, and that's definitely something which you have to do when you're younger, because as you get older, there's a lot of complications which comes into insurance coverage. Either they charge you through your nose for insurance premiums, or they flat out refuse to give you insurance altogether. And it's inevitable that certain comorbidities are found in most of us, and it's something which you cannot avoid, and you're better off filing for insurance and purchasing something when you're younger and keep renewing it when you're older.
Okay, so that all being said, the simplest way to get down to doing this is to open an Excel sheet and sit and do your numbers on that. First, know what's your current age, when you wish to retire, how much can you start investing, how much lump sum can you put if you do have any lump sum, what are your monthly expenses, okay, what will be your expenses when you retire, what will your major spends be, monthly or yearly, what you have forecasted, to plug in all these numbers. Then you can see where you are and where you need to go, and you can see what is the rate of return you need and how much time you have. When you put all these numbers in an Excel sheet, it is very simple to sit and calculate and see what needs to be done. Most of us find what all the information we gave you a little daunting and a little too much to process. But the best way to go about it is take a deep breath, open an Excel sheet, which all of us know, most of us know how to use, and start plugging in these numbers. And when you start plugging in these numbers, you can simply start calculating, and things will get a lot more clear on where to go and how to go. What do you say, Sashwat?
Yeah, and the Excel sheet, maybe this is something which we can cover in a video coming forward, where we look at specifics of how you can account for expenses, inflation, and such. But the general idea for this video is that you want to compound your expenses by the inflation rate, and you want a margin of safety even in this. Margin of safety is something which is a universal concept. It's not an investment concept. It's something which you need in everything. You need that margin of safety. And in this, your margin of safety is to say, yes, I expect my inflation rate to be somewhere between 5 to 10%. And what I'll do is I'll add another 2% for safety. And I'll assume that the worst case scenario, because you do not want to get caught out. The yes, it may be tougher for you to save up to that amount, and you may find out later on that you don't need so much money. And then you can figure out how to do away with that money, which is not going to be very hard for you. But the idea is that you don't want to get to that point and want 20% more than what you already have. That is a situation you don't want to get caught in. And yes, and for that you have to do specific calculations where You account for the inflation rate, you account for how much you're spending and what your quality of life you want to be. And once you account for these factors and you plug it into an Excel sheet, even if you're not making too many calculations, just seeing the numbers laid out gives you a lot of insights on where you're standing and how you need to adjust your quality of life and your investments to be able to reach the place you want to be in your retirement.
And to that argument, a simple thing is a zip calculator, like which I opened up just now and I'm looking at. If I just put 9,000 rupees per month at a Nifty index, and let's say I get around 13% average return for a period of
CAGR.
20 years. Yeah, 20 years, Nifty should give me around an average around 13%. In 20 years' time,
Definitely.
that 9,000 rupees would have grown into something like more than a crore. It's that simple. When I say 9,000 rupees, for some of you it might be nothing, for some of you it might be a lot of money, but it's just an idea to tell you on how easy it can be to calculate and to start. The reason why most of us fail in achieving our goals is because we fail to start. We just get daunted and imagine it to be harder than it is. Like exercising, weight loss, anything, we imagine it to be harder than it is, and we look at the top of the mountain and think, oh my god, I can't climb it. But if you remember, it's just a step, a single step you keep putting in front of one foot in front of the other, the one foot in front of the other. Before you know it, you would have finished reading the book, you would have finished climbing that mountain, you would have finished losing that weight, and definitely you would have started investing and would be well on your way to having your 2 crore, 3 crore corpus fund. What do you say,
Yes.
Shashwat?
Definitely. And this is an extension of the SIP versus lump sum video because most people think in terms of lump sum. That is not the way to think about investments. Investments are yes, it's great if you have lump sums, but the idea of investing is that you are able to put away a little bit amount of your income every month, every year for however long you work. And you will definitely be able to create that nest egg which you require, which you can then, if you don't require, you can pass on to your children and their children's children.
That being said, I hope you enjoyed our video today. I hope you found this content interesting. If you did find this content interesting, please do consider subscribing to our channel and turning on the bell notification so you'll be notified every time we come up with a new video. We'd like to thank you again for joining us today on Be Rich.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.